Everyone, and thank you for joining us for this webinar on improving after-tax returns within Australian equities, presented by Michael Maughan. My name is John Soteropoulos, and I'm the Business Development Manager at Yarra Capital Management, the proud partner and distributor of Tyndall Asset Management Funds in Australia. Now, before we begin, I'd just like to briefly introduce Michael. He has over 24 years experience in investment management and is portfolio manager of the Tyndall Australian Share Income Fund. In today's webinar, Michael will cover reassessing clients' portfolios as we near the new financial year. This is crucial, especially for those with Australian share strategies, where franking credits can greatly impact after-tax returns. Michael will delve into strategies for Australian investors to achieve growth and tax-effective income, emphasising the reliability of equity income funds over traditional assets and sharing his Australian equities outlook. Now, there will be 5 minutes or so at the end for general Q&A. But we're really excited to hear from your insights, Michael. Thank you.
Thanks, John. Good to be here. Clean shaven, unlike that photo on the screen, but I think still wearing the same tie. So we are here to talk about income, equity income. And what we're trying to do here is help you in your quest to create tax-effective portfolios for your clients that balance their income and growth needs. First of all, we're going to look at what the options you have for income. What options you have for income? Interest rates are up. Are equities still an appropriate asset to have in the mix there? Secondly, we're going to talk about what extra features an income-oriented equity fund can give you above a general equity fund. And lastly, we'll talk about some of the stocks that we're using to create these portfolios and achieve these outcomes. So I speak to a lot of you, and what you tell me is you're trying to achieve for your clients real income and capital growth. So let's start looking at how equities fare for achieving this. And we'll just start thinking about it at a market level, using the ASX 200 as a proxy for equities. So this chart is basically showing you the yield of different asset classes over time, over the last 25 years. The top line is the grossed up dividend yield of the ASX 200, and the other lines are bond yields, term deposits, the cash rate. So what you can see, what jumps out at me from this chart is the consistency of that top blue line, a very consistent yield. Yes, bonds are back being a relevant part of these type of portfolios, having deserted investors for the last 10 years. But the inconsistency of those equity yields and the capital growth, which we're going to talk about more in a minute, means that equities are probably still doing the heavy lifting for income portfolios and retirees. So the other thing we need to consider here is that inflation is still a thing. This chart is the same as the previous one, but adjusting for inflation. So as you can see, all of these yields are now back into the black, having been negative in real terms. But what you get from this chart is that equities, whilst all the yields are lower, equities are triple the real yield of fixed income. And as we're going to, and what I would take away from this is these yields aren't high enough to meet people's retirement needs. So we're going to have to look for more, and part of that is going to be capital growth. And that's what this is showing you. This is showing you that as we said before, over time, equity markets have delivered you sort of 4.5% yield, 6% grossed up for franking, but they've over 15 years they've delivered you nearly 11% total return. So nearly double that in terms of total return. And that's very, very important for all the things that we know, longevity, and just dealing with this, people's retirement needs. The second part of this chart that's really important is pointing out the importance of franking when comparing returns of different asset classes. 1.6% extra return from franking alone. So that is not an immaterial number, and something that you need to keep in mind when you're comparing the returns of different asset classes, because it's often not in the headline number. So that's all great. The equities seem like a good source of income and growth. So what does a specialist equity income fund give me that general equity fund won't? So first of all, let's think about why you would want to target more dividends, or more of your return to come from dividends. So I think this chart shows that pretty well. Again, this is sort of by year now, the return of the ASX 200 over time. The dark bars are the total return, and the light bars are the grossed up yield. And what you can see again is the consistency of those light blue bars, that income that you get every year, regardless of whether the market is up 30% or down, you are getting that income every year. So that's the sort of consistent part. So I guess the thing that this prompts me to think is, what if I could generate similar or better total returns, but get more of it from that kind of consistent income source? Well, that's what an equity income fund does. And this is an example of the dark bars, the Tyndall Australian Share Income Funds, grossed up dividend yield over time against that of the ASX 200. So what we're seeing here is, we've targeted a grossed up dividend yield at least 2% higher than that of the market. Over 15 years, it's been more like 3% higher than the market. But what you're getting here is full exposure to the growth from equity markets, but shifting that mix to be skewed to that safer, more consistent income component, transforming the nature of your returns. What that does, and if we sort of summarize it, so the returns of an index fund would be 53% of those would come from dividends, grossed up dividends, 47% would come from capital growth. Our fund has delivered an 11% return, very similar to that of the market over time. But 8.7% of that has come from dividends and franking credits. So instead of sort of call it a 55-45 split, you're up to almost an 80-20 split in terms of income versus growth. What that gives you as an outcome is a portfolio that should be in normal times less volatile, because of the nature of the returns and the nature of the underlying assets that generate those type of returns, more cash generative defensive companies. The other advantage of these types of funds is by generating that consistent income, when the market does have its ups and downs, you don't have to sell your stocks at the bottom of the market when we think about market cycles and getting access to cash to live off. So before we get into some examples, I think it's worth pointing out here what principles we abide by in approaching equity income. It's an asset class or a space that can be a little bit confusing. There's lots of different types of funds. And it's important to know that dividend yield, whilst it has very nice qualities, a company with a high dividend yield should have nice qualities like cash flow generation. If it's franked, it's paying tax. Implies it has a strong balance sheet. But in and of itself, it's a terrible way to pick stocks and value companies because it leads you into value traps. But this is exactly why income ETFs don't really work, because it's not a great way to pick stocks or screen the market. So what do we do? First of all, we leverage the skill set that we have, which is, a fundamental investment process proven over 35 years and a very experienced and well-credentialed team of analysts and portfolio managers applying that process, and who have been applying that process for a very long time. I've considered myself one of the new guys at Tyndall, and I've just racked up 17 years. Then what we do is we build a portfolio in a modern way, in that it's objectives based. So in the old days, people would set hurdles for a stock to make its way into the portfolio, and then you would get an outcome based on the net result of that. Instead, we start with the conclusion, the objective that we're trying to achieve, rather than setting impediments to that. So think about it. An old income fund would have been income-ish stocks, REITs and utilities, and the downside of that is it's very kind of leveraged to interest rates, very similar risk profiles. That's not what we do. It's not a two-stock portfolio of CBA and Telstra, which can be derailed by a banking royal commission or the government deciding to go and build the NBN. Our approach is a diversified fund that delivers you returns similar to the market, skewed to income. So the objective we set is deliver a much higher dividend yield than the market. We said a target of 2%. Maximize franking credits, it's a franked objective. Beat the total return of the market over time to prove that you're not manufacturing that yield and stealing it from capital. So we put less focus on managing risk by shrinking our investable universe, and it's reducing the pool in which you fish. Seems to give people some sort of false sense of safety. Instead, we manage risk more holistically. So we think about the risk of every individual company. I talked about the team that we have that have the sort of skills and experience to do that. And then we look at the overall risk characteristics of the portfolio once we've put it together to understand what the aggregate risks we're taking. You can only really do that in a diversified portfolio. I guess the last thing to point out that might be surprising to some people, I mean, equity income investing is for active managers. At its heart, an income fund is focusing on the parts of the market that are in REAP mode, if you like, that have sort of strong cash flows now and are returning that capital to shareholders now. So just like the value opportunities move around the market at different times, so too do the strongest cash flow generators. So that requires income funds to be actively managed, and they're not the set and forget portfolios that some people think they are. So let's get into some of the names and sectors that we're investing in to achieve these outcomes. So yes, for context, if we think about the PE of the market, it is elevated at the moment, higher than its sort of long-term average. But when we think about that, we need to break it down and look at the different parts of the market. So this is the PE relative to the market for the highest quartile of PEs in the market. So the most expensive stocks in the market, traditionally they trade on a 45% premium to average. At the moment, they're on an 83% premium to the market. So we can get kind of bogged down in these numbers, but the point of this chart is growth stocks are very, very expensive at the moment. We haven't washed through the sort of post-COVID boom that we saw in the ratings of these types of companies. This is important, especially in a market like Australia, where like our tech stocks have not seen the earnings upgrades that Nvidia and Google have seen on the back of AI driving earnings upgrades. So a lot of the performance of our tech stocks has been through PE expansion, which we think is unsustainable. On the other side of the coin, the lowest PE stocks in the market are not necessarily expensive relative to history. If anything, they're a little bit cheap compared to history. So we've got this bifurcation in the market. Yes, overall the market looks a little bit expensive, but there's a concentration of that in the growth stocks. So there are parts of the market that we think are still cheap and do provide value. By avoiding those more expensive sectors, we can protect the downside risk from investing in equities. So we're not just screening the market for high yield, as I said before. So what are we doing? Well, we're creating a diverse portfolio that can weather whatever macro environment we're served up. We have a large team that we're leveraging to do this, and that results in us kind of finding opportunity buckets, if you like. So we're not picking stocks based on them having a red or orange logo, as this chart might imply. What we're doing is we're looking for stocks that provide us certain characteristics. So the first one we're looking at there is undervalued safe players. Not unsurprising for us to have defensive stocks like Telstra in this portfolio. But Metcash is an interesting example here that provides maybe a little bit more. You might know Metcash as the grocery wholesaler behind IGA. And 5 years ago, we were worried that there wasn't a place for Metcash's business model in this market. Fast forward to now, and they've taken the benefit of, well, this started well before COVID, but they've taken the benefit of COVID to their business and people shopping more locally. And they've reinvented themselves to be able to leverage that scale that they have, which is something they'd previously struggled to do. If we think about it now, Metcash is a food, liquor and hardware group that has a lot of the tailwinds of Woolworths, Bunnings, or Dan Murphy's, but it trades at 13 times PE versus Wesfarmers at over 30. So we see this as a company that does have defensive qualities, is underpriced, but has also reinvented itself on the back of the strong earnings and cash flows through COVID to invest in growth businesses like Total Tools, Superior Foods, and some other hardware bolt-ons that are going to drive its growth going forward as well. And at the same time, we get a nice 7.5% grossed up dividend yield in that stock at the same time. Asset plays are, traditionally a staple part of income funds. And I think we approach this slightly differently maybe to others. What we really like when it comes to asset owners are companies that have got sort of uncorrelated assets, unique assets, but uncorrelated to the usual kind of GDP cycles. Aurizon's a really classic example of this sort of business. It owns 5,000 kilometres of railway tracks in Queensland that are a regulated monopoly. And then it owns an above rail business that's helping hundreds of Australian companies to reduce their carbon emissions by transferring volumes freight volumes from road to rail. Importantly, the earnings for this company in the short term, the earnings growth, is actually driven by what a horrible year they had last year in terms of weather impacts on their business. So we have really strong confidence in their ability to generate the forecast profits and growth this year, regardless of the economic cycle. And that's, it's hard to find assets like that or companies like that to put into the portfolio to provide that balance to more cyclical businesses. We do invest in cyclicals. You have to be very careful investing in cyclicals, especially when investing for income, because you don't want to be buying a mining stock that's still paying a strong dividend, but the commodity price has been falling for 6 months and next year's dividend is going to be very different. Ampol and Viva Energy, to the same extent, are great companies in this regard. Ampol is a refiner of fuel and a retailer of fuel at a time when global refining capacity has been underinvested in for quite some time. If we think about the 2 last refineries in Australia, the government has appreciated the need to retain these types of assets for national security reasons and have underwritten the refining margins of these businesses. So the old days of them going from profit to loss don't exist. They've been sort of underwritten so that the volatility of earnings in those businesses is very different now. So we expect a change in the rating and the multiple people pay for that. They're also benefiting from the recovery in air travel, cruising, as they supply volumes to those industries as well. And they've got improving convenience offers that they're investing in, and they've sort of proven that when they invest in and reinvent their sites, they get a return and can drive growth out of that as well. Both very, very healthy balance sheets and grossed up dividend yields of over 8%. And last of all, there'll always be room in our portfolios for our best kind of contrarian value ideas. That might be something like a CSL, which doesn't have a particularly strong yield but has great value qualities and brings characteristics to the portfolio that you can't really get in a stock with a yield. But in the case of G8 Education, we've got a stock that provides best of both worlds. It endured a torrid time during COVID in terms of the childcare industry. Attendances were the issue to start with, and then later the issue was staffing. They're now in clear air on both of those. We've got a new management team who are doing a very good job operationally, and we've got bipartisan government support for quality childcare, which is driving the demand side for childcare, and hopefully expecting some assistance for the industry on the cost of staff as well. Some sort of wage subsidies have been announced for the sector. These types of companies used to trade at a premium to the market because they had defensive qualities, structural growth in demand. That changed during COVID. We're expecting that to return in the near future, at the same time getting a nice yield out of that stock. So just maybe to bring it all to a head, this is the evidence, I guess, that we deliver what we advertise. 15 years of delivering a grossed up dividend yield of 8.7%. That's nearly 3% higher than the market, well above our stated objective. At the same time, we've delivered a total return of 11%, including franking, maintaining that kind of 80-20 mix of income to capital growth in terms of that total return. Running this type of fund is a constant balance between generating income whilst protecting and growing capital. And as you can see here, we've got 15 years of managing those dual objectives. So in summary, when you're trying to balance income and growth, I think we've proven that equities are a very good tool for delivering on that objective. They're also very tax effective, and we've got to can keep prompting the market to remember franking in when you're considering asset classes. There is value to be found in the market by avoiding the more expensive parts of the market. We think equities are still a good place to be. And I guess in closing, if you skew your portfolio towards income, you can reduce risk and volatility without compromising the growth aspects of investing in equities. So on that, I'll pause, and John, I don't know if you have any questions.
Yeah, thank you, Maughan. We have had some questions come through, so we'll open it up very briefly for Q&A. Just firstly, to kick us off, can you provide some insights into the current portfolio composition of the equity income fund you manage, including top holdings, sector allocation, and any recent changes that you've made?
Sure. Well, there's a lot in that. Let's maybe start at a sort of sector level, where we're finding value and where we've got exposures. We are overweight staples, consumer staples type companies. We mentioned Metcash earlier. But the market's been chasing growth in companies like Coles, Woolworths, Ingham's, the chicken producer, being left behind. And we know that the supermarkets inquiry is partly a factor in this, that we think will wash over with very little impact on the actual operations of those businesses. But they're generally just being left behind as the market's been looking for higher growth assets. We're also positive on energy. I think it's been proven in more recent times that gas is the only option for Australia in terms of a transition fuel to get us through to the renewables that are being gradually built, and to sort of balance the grid with those renewables. And so that's a paradigm shift in people's thinking that in addition to just the value and the underinvestment in gas production means that's a sector that stands in good stead still going forward. Insurance remains in a sweet spot. As much as we've all felt the brunt of premium increases, that actually is still dropping through to insurers' margins because they've had such high inflation in claims costs as well. So we're not finished on that story of improving earnings for the insurance companies, and hopefully a re-rating of them as well. We're more neutral on banks and miners. Banks are in a reasonably sweet spot at the moment, given that the peak in competition was probably 12 months ago, and we're seeing back when people were doing the fixed rate mortgage refinancing, that's abating, and we're seeing that's come through in slight improvements in their net interest margins. So a bit of a safe haven at the moment, the banks. Miners, positive outlook on copper, maybe slightly negative outlook on iron ore means that with their pullback in price, the miners look fair value as well. And then on the underweight side, we talked about tech, underweight tech, just purely on the valuation grounds, and the consumer, where we're expecting a bit more pain to come through for more discretionary retailers. The other part of your question was on changes to the portfolio. If you go back a few months, we were buying gold earlier in the year, which was an addition to the portfolio, really kind of part of portfolio management and risk management to deal with the political uncertainty and macro uncertainty that exists in the market today. Newmont was struggling post its merger with acquisition of Newcrest, and it had some production issues, which provided an opportunity for us to buy that, despite the fact that the gold price had already been starting to rally, thanks to, in particular, the Chinese central bank buying. So we were able to buy that stock quite cheaply halfway through the rally in the gold price. The gold prices continue to be strong, and the operational issues for that company are now well known, understood, and in the market's forecasts. So we've seen it play a bit of catch up to the other gold names as well. So that's been a good exposure that we added. More recently, going into kind of June dividends, we have been more neutral in our positioning in REITs and infrastructure stocks. They had been very weak. If you think about these types of companies, they're more leveraged to US interest rates than they are to Australian ones, and with risk to the downside on US interest rates, but not necessarily Australian rates. We're not necessarily positive, but we're less negative on some of these bond proxies. Things that we're buying was APA, which has, talking about rare and unique assets, its gas pipelines, definitely that type of asset, a largely unregulated monopoly. And the other one we were buying in that space was Region, which is sort of more local shopping centres anchored by supermarkets, more defensive in nature maybe than other retail property assets. And it's actually part of the market that there's still support for those valuations in direct markets, so those assets are still trading at kind of book values, which is encouraging and something that you're not necessarily seeing in a market like office when it comes to commercial real estate. So they're the things that we've been adding to. I think that
Great, Michael.
Question.
Thank you. Yeah, perhaps just one final question, just conscious of time. How does the equity income fund handle periods of market downturns or economic uncertainty? And what measures have been put in place to protect investors' income and capital?
Well, we've got 15 years of running this type of fund for these dual objectives. And if I think about, first of all, I think you've got to point out equities are a growth asset class, and this is an equities product. And you should expect sort of equity style volatility. That said, we've got dual objectives. We want to deliver a grossed up dividend yield 2% higher than the market, and we want to grow the asset base over time to prove that we're not generating that yield out of by stealing from capital. This isn't a product that manufactures a yield. So by moving to where the value is in the market, that's how we achieve that second objective. If we look at the portfolio, we own stocks like CSL and Aristocrat, not high yielding stocks, but they do provide value and capital growth for the portfolio, and we will make up the yield elsewhere. And as I say, 15 years of achieving the yield objective whilst making room in the portfolio for those type of stocks. A diversified portfolio, risk managed portfolios is how we balance risk reward. It's interesting if you think over time, to achieve the yield objective whilst finding room for those types of stocks in the portfolio, our best total return ideas, if you like, is exactly what's allowed us to deliver investors that kind of best of both worlds, consistent income and an asset base that grows over time.
Yeah, brilliant, Michael. Thank you. Very insightful. And thank you to everyone for tuning in today. Following this webinar, we will send you a follow-up email that's got a link to the presentation that Michael spoke to. And as a reminder, Michael Maughan runs the Australian Share Income Fund, which is well rated by Morningstar, Lonsec and Zenith, in addition to being available on most platforms and approved product lists. So again, thank you, Michael, for sharing your insights, and thank you to all that have listened. We appreciate your time and stay well.
Thank you.